Right, see markets these days, they're having big swings with the Iran war, and mostly what we expected to be safe haven sometimes turns out to be even more volatile, than risk assets. So you wonder, is it risk on or risk off? Where do you go, in this kind of market? So now we're going to analyze some of the stock picks from AfriInvest research. They're going to help us. They've done all the research at this point, and they'll give us direction in what to look out for, in this market. Stocks to watch right here in the Nigerian market. Joining for this now, we have Nathaniel Disu, who's an investment research analyst, AfriInvest West Africa, and he joins me right here in the studio. It's great to have you. Good morning.
Yeah, good morning, Laddie.
I can imagine, what's it like, with research guys, when you're seeing what's playing out so far, in these markets. You see the war in Iran. We didn't expect it to happen. It came, and we're seeing markets already gyrating, to what's playing out. How does it affect you guys, your daily lives, at this point first?
Well, it can be a struggle, to be honest, because especially when you look at the global macro situation, just like what you talked about in the US-Iran crisis and the likes, especially when it relates to the crude oil price, you can see a lot of volatility swings. Today, crude oil price will be over $100. Tomorrow, Trump will tweet something, it will be less than 90 something. So that can also weigh into decision making. So it's not quite easy, but we have to do our job.
And I'm sure you guys have done your research. You already have a plan, for 2026 for some, sectors. You're expecting maybe consumer goods will outperform. Then this happens, then you have to go back to the drawing board and say, you know what, okay, I guess this plan is not going to work. We have to pivot to something else. But let's look at your latest stock picks now. For the banking sector, you've seen the likes of Access Corp, Fidelity Bank, First Holdco, Stanbic. So what you're seeing there is the forecast from AfriInvest. They see Access Corp could rise 89.1%. That's for 2026. Yeah, Fidelity Bank, you're seeing about 82% upside potential. First Holdco, 29% upside potential. But to Stanbic, you're seeing a downside potential therefore of 21.6%. But let's start off with this big one here, Access Corp. What do we see? What are you seeing that we're not seeing that could take Access Corp this high?
So for Access, it goes beyond the 12 months target, so it's more like a long-term play, because looking at Access Corp, it still remains the largest, largest lender in terms of assets size and the like. So, and Access historically do a lot of acquisitions and the like. So we expect that to play out in the long term. So it's more of a long-term plan beyond just the 12 months target. So that's what we are seeing for Access. So for Fidelity also, when you look at Fidelity is an interesting case, because if you look at the tier 1 lenders and look at the tier 2, amongst the tier 2, Fidelity tends to be like the outperforming company, or let's say bank, in that space. If you look at the asset size, they are kind of punching way higher. So we expect a lot of upside in Fidelity Bank. And also Fidelity has an international banking license, and they've also met their CBN recapitalization mandate, and likely with virtually all listed banks. We've seen, I think the last time I checked the data as of 24, that was like yesterday or 2 days ago, over 30 banks have met that threshold. So we see a lot of renewed investor sentiments in the banking sector. We see a lot of confidence in that sector, and that's why we are a bit optimistic on the banks.
Then, for downside, you're saying Stanbic could be down 21.6%. And, I did look at the data, the capital importation data for Q4 2025. As usual, the banking sector got most of the funds, as usual.
Everybody loves banks.
At this way, everybody loves banks, and it's sad to see, the manufacturing side of things, getting, the short end, obviously, when it comes to capital importation. So talk to me about Stanbic, 21.6% downside. What are we seeing there?
So for Stanbic, it's more of just price movement, basically. And like I said earlier on, in terms of the recapitalization, etc., all banks have met that threshold. But when it comes to target price picking, at times when you put a target price, a stock jumps way above that price, and it's not every day you tend to change your target price. So that's one of the things that we are seeing in Stanbic, but it doesn't mean Stanbic is not
right.
A good
So
thing.
if you look at the banking sector, definitely we have a lot of positives, there on that chart. But for consumer goods, that's the next one. Just one, and that's Nigerian breweries, has the upside potential of about 17.2%. But we're seeing red, for the rest. The likes of Boer Foods, we're seeing downside potential of 36.7%. Down to sugar, 50 point. That's huge. 50.7%. Downside potential. So I'm wondering, is this connected with what we're seeing play out with the Iran war?
So for consumer goods, interestingly, last year was kind of a recovery phase for the consumer goods sector. In 2023, when the FX liberalization happened, consumer goods and other manufacturing-based companies, they tend to suffer because of the impact of the FX losses. But in 2025, we saw most of the consumer goods companies recover, and we expect that recovery to also play out in 2026. And beyond just that, apart from that, even the stock recommendation on AfriVest is an interactive stock, so it gets updated real time. So currently there are other stocks within that consumer goods bracket that are also positive. We see NASCON is there, and just like I said earlier on, there are some stocks that after the target price picking, it tends to overshoot. Like Nestle, for example, is just -3%. Unilever is just -2%. So it's still not. But for Boer Foods and Dank Sugar, especially Dank Sugar, I think what we are saying is that apart from other, like I said, most consumer goods companies have recovered in terms of their bottom line, but Dank Sugar is still in the red. So that's still something that is still playing out in that company. But if you look at the FX losses, it has minimized. I think 2024, the FX losses was over 300 billion. Now it's about 100 billion thereabouts, going lower. So we expect more recovery to happen in Dank Sugar. So when the data feeds into what we project, they are going to be changing.
And definitely, to our viewers, definitely this is not investment advice. This is not financial advice. These are recommendations. It could happen, could not happen, but this is based on research. But generally, looking at consumer goods, you did mention coming from a place of recovery. At this point, before now it was FX losses. You see their overheads shooting up. But now I'm looking at what's playing out with the energy crisis. At this point, everyone's paying so much now for fuel, for diesel. At this point, I'm guessing this might impact them negatively when we see those earnings for 2026.
So for consumer goods, if you look at Boer Foods, for example, in their unaudited figures, their revenue was 1.8 trillion. But if you look at their cost, it's 1.1 trillion. And this is the first time they would cross the 1 trillion threshold in terms of cost. But if you look at their bottom line, it's over 500 billion. So one of the things that we see, is particularly in that company, that they are able to pass on the cost onto consumers, and that's one of the things consumer goods companies tend to do. Maybe that's why they're even consumers. So they tend to pass on that extra cost, and even for the brewery companies, we still see that same thing happen. It's easier for them to pass on, and with the whole Iran crisis happening, fuel costs, diesel costs rising, we are expected, especially for Q1, we are likely to see a spike in their cost because but at the end of the day, they will still be able to pass on, especially for the brewery stocks. 2026 is an amazing year. For example, we would have the World Cup in June, and due to it happening in different time zones, North America, so it's going to happen lately around that ninth period in Nigeria. So there are going to be a lot of activity from football.
Okay, the guys that like to drink
so
and
that
watch
would
football,
also weigh into their revenue, and it's a pre-election year. There's going to be a lot of activity, so we expect more demand for the breweries stocks, and that would overall play out in the consumer goods sector.
All right, definitely a lot to unpack there, but generally, I keep saying this, being an investor right now is no easy task. It almost seems you might be safer just being in cash, at this point. But definitely we have that animal spirit. You know, some
Yeah.
of us just believe there should be a way I can turn, 10 naira into 50 naira,
Yeah.
regardless of what's, playing out
there are
so far.
still opportunities
What's the philosophy navigating this 2026 in your opinion?
There are still opportunities available in the stock market generally. If you look at the consumer goods, the oil and gas sector, oil and gas is the best performing sector on the NGX so far. As of yesterday, the oil share index has gained about 29% thereabout, but the oil and gas sector has done over 60%. So there are still opportunities there, and one of the drivers of that rise is Aradel and Seplat. Aradel alone has gained over 80% year to date, while Seplat, I think about 50-something% year to date, and we weigh in the market capitalization and the like. So that is still an opportunity in that sector. There's still a lot of opportunities, even in the banking sector. Looking at Zenith Bank, for example, Zenith Bank has done, I think, over 60% or 70% year to date so far. GT has done over 50%. So there's still a lot of opportunities within this sector. So it's more of you getting the right advice, the right ideal research recommendation, and
that's what shocks me about major markets at this point. In the midst of all of that fire, all of that confusion, in the market, you're running away from it saying, you know what, this volatility is too much for me. But you now listen to or check the performances of some of these asset classes, and you see that they're up 50%.
Yeah, all the asset classes is not going to, get affected negatively, except if you have a kind of a COVID disruption that happened 6 years ago. But the Iran crisis is even weighing in positively for the oil and gas sector. If you look at it, and also on the NGX as a whole, January did about 6.3%, February did about 16%. That was like the peak so far. While March is more of like profit taking, around 4% thereabouts month to date. So there's still a lot of opportunities despite the gloom, because whenever there are crises or this kind, it's not all sectors that is going to be affected.
Right.
Gold, for example, has done amazing well this year.
Yeah.
So when you
coming in from 2025,
exactly,
but
so there are
a lot of volatility right there with gold.
So that's why you need to play your cards well.
Fantastic. Yeah. Thank you so much, Nathaniel Disu, investment research analyst, AfriInvest West Africa. Thank you for giving us some direction this morning.
Yeah, thank you, Ladi.
Thank you.